Hi, welcome back to our course on IPO. Last week, we have discussed the general IPO process and have introduced comparable company analysis and DCF analysis. In this week, we will continue our discussion on several important concepts related to IPO business. The first one is Roadshow. When Roadshow starts, senior management and the lead underwriters travel to major cities to meet with potential investors and discuss the planned offering. For example, during Alibaba IPO, their IPO team traveled to New York, San Francisco, London, Hong Kong, and Singapore. An important purpose of Roadshow is to market the security to potential investors by providing information about the offering. As we have discussed last week, before a roadshow starts, the ECM bankers will prepare reports and organize meetings to teach salespeople in the trading division about the offering. The ECM and sales team together with company management will then talk with potential investors during the roadshow using a red herring prospectus. In practice, information released in the roadshow is usually limited to what is covered in the red herring prospectus in order to conform to regulations of the waiting period. As we have learned in the second week, waiting period or cooling period refers to the period between the filing of a red herring registration statement and the approval of the registration statement by SEC. During the quiet period, firms are also not allowed to disclose additional information other than the prospectus. The waiting period requirement protects investors from unregulated information disclosures. Another important purpose of a roadshow is to gather information about the demand from potential investors through a process called bookbuilding. Bookbuilding participants are limited to institutional investors and wealthy individuals. These investors are very important, and investment banks maintain long-term relations with them. In the bookbuilding process, the underwriter announced an indicative price range, and institutional investors submit bids for the shares. Investors submit their bids in three methods, including strike bid, limit bid, and step bid. In a strike bid, investors only provide information on the number of shares they want to buy, which means they are willing to buy any given number of shares at almost any market clearing price. In limit bids, investors provide the price they are willing to pay alongside with the number of shares they can subscribe. In step bids, investors submit several limit bids, specifying the number of shares they are willing to buy at different prices. After collecting the bids, the underwriters will aggregate them into a demand curve and choose the issue price. The price is not set to any predetermined rules. It is the job of ECM bankers to balance the need of issuing company who wants to sell at a high price and the need of institutional investors who want to buy at a lower price. The issue price is usually set lower than the market clearing price. Market clear price means the price at which supply meets demand. The practice of setting a price lower than market clear price is called leave money on the table. It exists as a reasonable profit margin to give incentives for institutional investors to do research about pricing and participate in book building. After secondary market trading starts, trading price would often rise above IPO price. For example, Alibaba set their IPO price at $68. The secondary market opened at $92.7 and closed at a price of $93.89 on the first trading day. This means that the market priced Alibaba at a 38% premium to its IPO price. The phenomenon of a price increase on the first trading day after IPO is called IPO underpricing. IPO underpricing is well documented in stock markets all around the world. Okay, thanks for watching. In our next video, we will continue our discussion with pricing and the allotment of shares after pricing.